Hello everybody, this is the fourth video that I've done today. The problem were the first two of them didn't have any audio. So anyway, Ken Creager from BlackSwan Financial Advisors here, and hoping to do kind of a short video. The first take of it took actually a lot longer than I thought it would, but I just wanted to talk a little bit about this collapse and this mess with the Silicon Valley Bank failure and collapse, and the subsequent collapse and failure of other banks, and the Fed and the government and everybody stepping in. So anyway, this is a video for educational purposes only. Remember that BlackSwan Financial Advisors and myself, we are supporters of the community at Possibilities Achieved, which is a community that is set up for families who have family members with special needs, and they can get support and resources and access to information and share knowledge and information, and actually learn about education and government benefits and finance and estate planning and all those things. So anyway, let's jump right into this. I was thinking about this because what's happened with Silicon Valley banking actually happened to one of my family members in the 2008 to 2010 crisis. The exact same thing destroyed their retirement. So what exactly happened with the SVB collapse? And this, you could just see here as I'm talking that this collapse is just, the effects of it are just starting to be felt, and it's going to ripple through the whole system. And all of a sudden, 95% plus of the depositors at Silicon Valley Bank, didn't even qualify for the FDIC insurance. So everybody else gets to bail them out. I can say for sure that if it was me and my retirement that blew up, that I would not get bailed out by the government. And there's a really good chance that your small community bank, if it blew up, it wouldn't be bailed out by the government either. But I just want you to see kind of the impacts that are expected here. Part of the problem is this liquidity crisis, and the liquidity crisis was caused in part by Silicon Valley Bank investing a lot of their depositors' money, too much of their depositors' money, into longer-term government bonds. And these are supposed to be the safest investments in the world. U.S. Treasuries, mortgage-backed securities, guaranteed to pay you out. And this is a cornerstone of the traditional 60-40 stock bond split retirement portfolio, that kind of once you get into retirement, maybe it's more like 40% stocks and 60% bonds. But the bonds and the stocks are not supposed to be correlated, and when stocks go down, bonds go up, and when bonds go down, stocks go up, and all that good stuff. And that portfolio just got smashed in 2022. The S&P was down almost 25%. At one time, it was down more than that. At one time, the 10-year TLT bond fund, the ETF, was down 34%. And so what happened with Silicon Valley Bank is a few years ago, they bought these bonds that were, yielding 2-3% out 8, 10, 12 years. Guaranteed, government's going to pay them. The problem is that since interest rates have been going up, and by the way, bond prices and interest rates are 100% inversely related. When interest rates go up, bond prices go down. Guaranteed like gravity. And so those bonds, those long-term bonds, like I said, at one point they were down over 30%. So probably on average right now they're down 20-25%. And so they were sitting on these unrealized losses of billions and billions of dollars. And what happened is, somebody said something, and people are getting worried that the bank is sitting on all these losses, and so they got worried that, well, maybe this isn't a safe place to be, and so they all took their money out of the bank. And so we had a good old-fashioned bank run because of this liquidity crisis in the sense that Silicon Valley Bank did not have enough cash, did not have enough income, didn't have enough cash on hand to pay out the people that wanted their money back. And so they had to sell a lot of these bonds at a huge loss. And then more people wanted their money back. They had to sell more. And pretty soon it's a big mess. And this liquidity crisis is what caused the collapse of Silicon Valley Bank. And you've probably been hearing a little bit about held to maturity. If a bond can be held to maturity, the return on that bond is already known. It's already figured out. If a 10-year treasury bond yields 4% and you hold it to maturity, you will get 4% a year, and at the end you'll get paid back all your capital. So that's pretty good. Usually it's a pretty good plan in retirement. But like I said, I know personally somebody in my family, they retired in about 2006, 2007, and they had maybe $700,000 or $800,000. Their financial advisor put them into some fixed income investments and bonds and stocks and everything, and everything should have been peachy. But then the 2008, 2009 collapse happened. And the bottom line is that what you need to do is sit down with your financial advisor, and you really need to think about the income that you're going to need during retirement. You need to look at your Social Security, your pensions. What are you going to be getting? What guaranteed income will you get? And maybe supplement that with some annuities to get the income that you're going to need in retirement. But then you need to really think about what would happen if you needed to take out more money than you're planning, and you have money tied up in bonds, or you have money tied up in the stock market, and it's down 50%. So that's what happened. They started taking out more money than they had planned, quite a bit more money. But the problem is that the market, their portfolio, had lost 40-50%, and they're taking more money out than they planned. And they have the same exact problem that Silicon Valley Bank did. They had a liquidity crisis. They didn't have enough cash on hand to cover the expenses that they had. They needed to take more money out. And so they basically had to run on their own bank, on their own retirement bank. And it destroyed them. And within 3 or 4 years, they had $30,000 left. And they're in retirement now, living on Social Security, and have no extra income. So what could they have done different? What caused the problem? Well, what you really want to do, again, you need to plan for the income that you're going to need in retirement, and you need to make sure that you get that into guaranteed income for life. So you won't run out of income, and that'll cover you in all cases except for those unknown situations. The most likely catastrophic event that will destroy your cash flow and require you to take extra money out of your retirement is probably a health related issue, long-term care or something like that. So in your financial plan, you really need to have some risk management in there, and the only thing you can really do for risk management is life insurance. Permanent life insurance, not term insurance. As you get older, term just becomes way too expensive. And the best time to get life insurance is when you're young and healthy. And if you have 40 years to build it up, it can work out a lot better. But even if you're, in your 50s, early 60s, you might be able to get something. But you need some permanent life insurance, and most policies that I've seen are just designed very poorly, and they're really designed for the agent to maximize his commission and not to maximize the performance of the cash value life insurance. So you need to get a policy that's designed properly so that these are investment grade life insurance policies. They have an investment portion. You can take money out anytime you need it, and it is tax-free money. And if it's designed properly, you can get 4, 5, 6% guaranteed return. Doesn't matter what interest rates are doing. It doesn't matter what the stock market is doing. It will get a guaranteed return of 4 to 6% tax-free until you die. And then you get the death benefit, which actually pays out even more. But one of the key points about this is that liquidity crisis that could be caused by a health-related expense is the life insurance it has living benefits, and you can tap into the death benefit while you're still alive and use it to pay for terminal or critical health issues. You can get access to that money early and use it while you're still alive. And that's probably one of the things that destroys more retirements than anything else, is that long-term care situation. And almost 70% of us are going to need, wait till the doorbell goes off. Ding dong, ding dong. But 70% of us are going to need some kind of long-term care coverage, and you need to plan for that. So the life insurance, or maybe you have some other asset that you can use. It's basically a buffer asset, and that's really what you're trying to do, is set up a buffer asset, and you're trying to diversify into different assets that perform differently and hopefully are uncorrelated with each other, and they work differently in terms of different economic environments. And so maybe you do have some stocks and you do have some bonds, and you plan on, as long as you hold those bonds to maturity, you're going to get exactly what you thought you were going to get. It's if you have to sell them when they're down, and the same with stocks. If you have to sell them when they're down, that's when you're going to have a problem. So you might have real estate, and we found in 2008 and 2009 that real estate can go down. And that's another case where, look, my brother bought his house in 2007 in the Phoenix area, and 2 years later, it was worth 70% less than he paid for it. Okay, so if he was counting on having an asset to help him in retirement, and it lost 70% of its value, and then you have to sell it because you have this liquidity crisis and you need to pay some health bills or whatever, you're in big trouble. And the other thing about real estate is, how about having to qualify and have good credit to get access to your own money, right? So guess what? My house went up in value a lot over the last couple of years, and so I went and got an equity line of credit on my house. So I wanted to get that in case I had a liquidity crisis and had an emergency. And I do have a line of credit. If I need some money, I can get it at 8.5% interest. Okay? So it's also, that line of credit has been affected by the interest rate being set by the Fed. So again, that's the same as losing all that Silicon Valley Bank. So if you have life insurance that's going to go up 4, 5, 6% every single year, no matter what, and this is your buffer asset, and that when your other assets are down, you need some extra money or you need some money to live on, you go get it out of that buffer asset and you use it until your other ones recover. And when they recover and they do well, the stock market does 35% or whatever, then you take some of that earnings and you pay back into your buffer asset. And so that allows you to survive these catastrophic liquidity kind of issues that happen to Silicon Valley Bank and these other banks. So anyway, I would encourage you to talk to me. I can help you come up with a plan just for you. And it's a multi-pronged approach. It has to be a balanced approach. Again, I'm with the community at Possibilities Achieved. I have a 20-year-old daughter with Down syndrome, and I specialize in financial and estate planning for families who have family members with special needs. It takes some special planning to deal with that, to make sure you maximize your benefits and the government benefits and maximize the return on your dollars so that you can have a successful retirement and so that your loved one can have a successful, secure financial future 40 plus years after you're gone. So again, educational purposes only. I hope you're watching my videos and I hope they're valuable and you learn something. So anyway, the Silicon Valley Bank situation brought back some very painful memories, but you can plan for being able to handle that type of situation. Again, thanks for tuning in. Ken Creager from